Greetings from Memphis, Tennessee. We're adding a video to the 2023 Q1 Resilient Asset Management client letter. We've sent an email to accompany this video that talks about some more client-specific matters. For this video, we're going to focus more specifically on the current banking crisis. The depth and breadth and complexity of the situation we thought would be better explained with a video with some pictures and just some narrative comments there. So we'll jump in with the just with some banking 101. So no matter what bank you choose to do business with, whether it's a very large JP Morgan, Wells Fargo bank or a smaller local community bank, when you go deposit your money into the bank, they collect deposits on their balance sheet, assets and liabilities, on the liability side of their balance sheet. So when you deposit money into a bank, that actually creates a liability for the bank because they have to provide you the funds if you want to take those funds out of the bank at a later date. So that's a liability. So they collect all these deposits from many people, okay? And those deposits sit over here on the liability side. Now, once they have enough money they gather enough in deposits, now they can go out and start making loans. And those loans go on the asset side of the balance sheet. So normally you would see the liabilities or the deposits, the interest rate on those instruments would be quite low relative to the asset side. That's how the bank makes their money, on a spread between the asset interest rate and the liability cost interest rate. Okay, so that's banking. There's obviously a lot more complexity goes into banking, but at the very bare bones of how banks do business, they collect deposits from many depositors, and then they make loans and they assess credit and all those things so that they can then make a return on the spread between what they're earning on the assets and paying on the liabilities. Okay, so the deposit base comes from various funding sources. You can deposit your paychecks and whatnot, so that you can then go do you pay your bills and do normal banking functions. There's certificates of deposit. They can borrow money from the federal government. Lots of funding sources for the bank. But this is what's important to realize, is that when banks have liabilities over here, their assets over here, in order to increase their rates of return, they employ leverage, meaning that they have significant borrowings over here to generate more assets, and that increases their overall earnings. So banks employ a lot of borrowed money. But all during that time, when you have your money on deposit in the bank, they have to be able to provide you the funds if you withdraw them. But the nature and the spirit of banking is that most people who have funds on deposit in the bank are not all going to want their money back at the same time. Okay, if that were to happen, then the possibility exists that a bank would not have enough funds available currently to pay all of their depositors back. Now, they could pay some. You want to close your bank account, or you need to take money out to make your mortgage payment, or whatever it is, that's fine. But if all depositors were to withdraw all their money collectively at the same time, that would create a very large imbalance of the assets and the liabilities for the bank, or at least on the timing of them. Okay, so a lot of leverage is used within the banking world. Okay, so one of the things that they organized during the Great Depression was, during that time, people lost confidence in the banks, because if they went and they deposited their money into the banks, there was no assurance that they were going to get their money back. Okay, so confidence is a big deal with your financial institution. So what the federal government, the system that they devised, was this Federal Deposit Insurance Corporation. So the FDIC is an insurance structure where banks pay a premium into a fund, and then if a bank is to fail for whatever reason, then the depositors in that bank are made whole on their deposits. This construct, especially back in the Great Depression time, gave people confidence in the banking system. They could actually go to the bank and use the bank to do the normal banking functions that people had: savings, depositing paychecks, making payments, or what have you. So that was the mechanism that they used to instill confidence back in to the banks. So that amount of FDIC insurance was at the $100,000 level for many, many, many years. And then in the Great Financial Crisis back in the earlier 2000s, that amount was raised from $100,000 to $250,000. Okay, so that said that if you had on deposit $250,000 or less and the bank failed, then your bank might fail and it might have a new name or be sold to another institution, but you as the depositor were going to be able to be made whole on your entire deposit. Okay, so that was the mechanism that they used for that. Well, if you go back in time to when the pandemic started in 2020, I've made this green line considerably bigger here because what happened during that period of time, if you can recall, is that in March of 2020 we had the shutdown, and all during that time businesses were in a very precarious situation because their income streams, i.e. being open for business, were now effectively cut off. So at the time, the federal government decided, well, the federal government is going to be the economy for a period of time. So if you can recall, we had PPP money, we had employee retention tax credit, which came along a little bit later. Student loan payments were paused, and then there were various stimulus programs all throughout, either direct stimulus payments or relief of some sort. Long story short, a lot of money rained down on the certain individuals, on everybody, to include businesses. So that made cash on hand go up dramatically, especially for businesses. So what do? Well, that money is going to find its way into the bank. Again, this is on the liability side of the balance sheet. Okay, so now banks have all these deposits, okay, but loan activity during COVID was curtailed because many businesses failed. Some of the better businesses now had a cash infusion, so they had no need to increase their loan activity. So, in short, many banks had a lot of cash pile up into their deposit base. Well, what are they going to do? Well, they can let the cash sit there, or even though they can't make any loans, what they can do is they can go and they can buy financial instruments that are going to earn a rate of return. If you recall, during COVID, when interest rates were cut down to zero, we were earning nothing on our deposits in the banks. Okay, so if you had $100,000 on deposit in the bank, you may earn a couple cents, but it was a very, very small amount. So the bank said, okay, what some banks said is, I'm going to take the money that's on deposit and I'm going to go and I'm going to buy bonds or some kind of instrument that's going to give me a rate of return. Well, the short-term instruments were earning very, very small amounts of money. And as you know, the longer you go out onto the treasury curve, or you can buy a 1-year note, a 3-year note, a 5-year note, a 10-year, a 30-year note. Well, the farther out in time you go, the higher interest rate that you're going to earn. Well, since they were earning zero for the near-term stuff, they bought a little bit longer term stuff so they can earn at least a small rate of return. This is what the Silicon Valley Bank did, is that they bought assets over here that were 5 or 10-year notes, not shorter term notes. And at the time, that seemed to make sense because interest rates were so low and they were earning some return on the money. Okay, well, let's pause on that for 1 second and let's go back to talk about savings bonds. Okay, if you remember when you were a child, I know for me, my grandparents would frequently buy me a savings bond. If you look, I'm going to talk here about how these different instruments work that Silicon Valley Bank used. But we'll explain it by this Series EE bond that we probably got, most of us had received when we were children. At the time, you would open the envelope as a gift, first communion, whatever it is, birthday, and this bond would say $100 on it. You think, wow, that's like a $100 bill. Well, no, that's not the case. The person who purchased this for you only paid $50 for the bond, even though this said $100 here. But what the implicit understanding was that it's a savings bond. So the longer that you held the bond, then the value of the bond would go from $50 to $100 over the course of many years. Now, during the interim, you could sell the bond whenever you wanted to, and you would earn how much ever time it had elapsed between when the bond was purchased and when the bond was sold. That's the interest that you would make above the original $50 investment. Okay, so now how does this apply to the regular capital markets on that moving beyond savings bonds? Well, I'm going to use a very specific example of what one individual with whom I'm familiar chose to do for a treasury-related solution for their housing situation. So go back to 2022, and housing prices are high. These individuals sold their house, and they had to pay off their loan, but there was cash left over after the house. And they knew that in 2 years, they were going to purchase another home. Okay, so they want to do something with the money for a 2-year period of time, so that when that 2 years was up, they would get their cash back plus a rate of return, and that would be the down payment for their next home when they knew they were going to be purchasing another home potentially. Okay, well, using the same savings bond example, they had $200,000 cash. Okay, so what we did is on May the 26th of 2022, we bought a $200,000 face amount. So instead of the amount being 100, it was 200,000. Although this was a electronic transaction, so there was no paper bond. We bought a $200,000 security, a treasury bill that was due in February of 2024, when they knew they were going to need the money because that's when they were going to be in the housing market again. And what they had to pay for the $200,000 that's going to be worth in the future, they paid $192,440 today. Okay, so they pay $192,440 today, and they know for a fact that in February of 2024, that same instrument is going to be worth $200,000. The difference between the two would be the interest that they would make on their funds. Well, at the time, and the federal funds rate was 1.75%. There had been just a couple upticks from COVID where they started to raise interest rates just a little bit. At the time, inflation was transitory, didn't know how long this thing was going to go on for, but that's where we were in the world at that point. Okay, so as time went on over the next 3 to 6 months, the federal funds rate moved from 1.75 to 4%. Okay, well, when you get into the treasury world, okay, you know at the end that your treasury is going to be worth $200,000. Okay, but what changes in the interim is the interest rate, and as interest rates go up, okay, by the current selling price, when you go to buy the same $200,000 security, is going to be less because the interest rate has gone up. It's higher, so you're going to earn more in interest over the same period of time. Well, what that means is that for the securities that have already been sold, on the run securities, their value has to come down so that they match what's currently being offered in the marketplace. So for this particular bond, between May 26th of 2022 and November 1st of 2022, the value of this security went from $192,440 down to $188,810. So there was a net loss or a unrealized loss in the security during that period of time. That's why they say when interest rates go up, prices go down. This is a very direct example of that. Okay, well, for some people this could be a problem, because if you've had to have the money on November 1st, you would have had a loss. Okay, but these investors know that they don't need the money until February of 2024. So if they just hold on to what they've got at this point, they know that what says $188,810 on November 1st in 2022, they know that on February 1st or whatever date it is in 2024, this security is going to be worth $200,000, and they're going to get the $200,000 back that they were promised. Okay, so As they start to approach the maturity date, even though the interest rates kept moving higher, the value of their bond kept going up because they got closer and closer to the maturity date. And the mechanics of how bonds work means that this price discrepancy between 200,000 and 191,000 is going to close as they approach the maturity date. Okay. Well, getting back to banking 101. So what happened at Silicon Valley Bank? Well, they purchased a bunch of securities here using kind of the same logic here, but I'll explain how it was subtly different here in just 1 minute. But this big liability deposit base that before was PPP money, ERTC, student loan relief, and stimulus payments, as you know, those things all stopped at a point. And then inflationary and all these other pressures started to come in, so people started to use their money for other things rather than just have it sit in the bank. Okay, so what happened at Silicon Valley Bank was, hey, I want to get my money out. Okay, so one person takes out their money. Well, as word started to spread that a lot of big depositors who had their money at this bank were going to start withdrawing their funds, Silicon Valley Bank had a liquidity problem because they wanted more and more people wanted to pull their money out, but the money was tied up in these investments that they made into the securities that I just mentioned before. But the problem with Silicon Valley Bank, and this gets to my next slide here, which is this particular security that I described previously was a 2-year treasury, 2 years. Okay. What Silicon Valley Bank purchased were much longer term securities, 10-year securities and beyond, perhaps. So the thing with interest rates is as interest rates rise, the longer term that your security is, the more impacted the current price of your bond is. Let me give you a very specific example. This was a 2-year treasury. Had this same mathematics worked out for a 10-year treasury, then instead of this number being 188,000 5 months after the bond was purchased, this number would be 134,000. Okay, so the problem that Silicon Valley Bank had was that they took in deposits for X, they paid X for longer term investments, and as the interest rate story started to unfold, the value of X of their investments became point Y of X, or a smaller amount. And then when they went to sell those securities to meet the demand for the withdrawals, that's where there was a mismatch in their assets and liabilities, and ultimately the bank failed and was taken over by the FDIC. So what happened was they had the withdrawals, but the other issue they had was that they had many people who had deposits on the bank above the $250,000 limit, which are uninsured deposits. Okay, so above $250,000, there's no insurance provided. FDIC is only up to $250,000. So this created a systemic problem because if a bank like Silicon Valley were to fail and there were a lot of uninsured deposits, a lot of people would be out their entire money. And if you recall, over the weekend when they were after the bank had failed, the Treasury Department and the FDIC and the government essentially said that all deposits, not just those below $250,000 and below, would be made whole. All depositors would be made whole. Their decision for that was to stem contagion within the greater banking industry throughout the country and perhaps the world. So as I alluded to before in the note that I sent a couple weeks back, philosophical question of whether or not that was the right decision or not. It's not my place to give you try to ram my opinion down your throat. But the decision that was made was that all the depositors will be made whole. And it seems that contagion, that has stemmed contagion within the banking world, at least temporarily. Now, does that mean there's not going to be cascading effects down the road of regulation and whatnot? That's an open question. But I think down the road you'll probably see something like that. But for the time being, it seems that things have sort of settled out a little bit since that happened. Okay, so what does this mean for you? Well, for the vast majority of resilient asset management clients, the funds on deposit at deposit institutions covered by FDIC insurance are below $250,000. So what does that mean? No matter where you bank, so long as you have less than $250,000 there, no matter what happens at the bank, you are going to be made whole. That's fine. And another reason that they do that is that you don't want to be assessing the assets and liabilities of a bank before you go deposit your funds there. You just want to, you as the depositor want to go there, you want an ATM card, you want a credit card, perhaps you want a mortgage. But the bottom line is you don't want to worry about the solvency of the bank. You want to just use the bank for the services for whatever that is that you're looking for. So for most people, the $250,000 issue is not a factor for you at all. And in the broader scheme of things, it seems like the banking world has not been significantly adversely affected by this. It seems like the problems that surrounded the bank were the Silicon Valley Bank were limited to a very narrow spots within the banking world, and that's good because as the banking system has been built and reformed to be robust to handle these sorts of situations. Okay, so now so that covers all the banking things, and I don't know that there's anything that anybody should be particularly worried about. But if you do have deposits that balloon above that amount, certainly you can look to mitigate that risk somewhat. But for the most part, the $250,000 limit is not much of an issue for our firm's clients. Okay, so now let's talk about the broker-dealer world. Okay, so our custodian is Shareholders Service Group, SSG for short. So unlike a bank where when you have make a deposit into the bank and that creates a liability on their balance sheet, even though we use SSG as our broker dealer, SSG does not custody the assets. So when you have stock in Apple or an S&P 500 index fund, and SSG is the broker dealer for those assets do not sit within SSG's corporate structure. Okay, rather in the broker dealer world, they have to have a custodian. Okay, now the the custodian for SSG is the Bank of New York Mellon. Okay, so Bank of New York Mellon, one of the largest custodian firms in the world. When you own stock in, like I said, Apple or whatever fund, those assets actually live and are custodied at Bank of New York Mellon. Okay, then based on what happens within your assets, whether we're buying, we're selling, there's transaction costs, there's various fees that, associated with doing business at SSG, then the income from those transactions flows into SSG's income statement, but the assets are still at Bank of New York Mellon. So if SSG were to make bad business decisions within their corporate structure, make a bad acquisition, expand too fast, hire too many people, what have you, and SSG were to fail, your assets would still be at Bank of New York Mellon, and you would be able to move those assets to a new custodian or have a new broker dealer service those assets for you. Okay, so that is a much different construct than the banking system. Okay, now in the broker dealer world, they have what's called SIPC protection, which is limited cash protection up to $250,000 and securities up to $500,000, but that's against fraudulent theft type of activities, not failure. That's why when you have your assets over in a place like Bank of New York Mellon, they are walled off from your broker dealer, and everybody who does brokerage custodies their assets at a different institution. It's one of the rules that they have to follow in order to do business. This was a very big deal in the Bernie Madoff scandal, because Bernie Madoff, supposedly, he was the broker dealer, but he was also the custodian of the assets. So there was no third party who was making sure that the 100 shares of Apple that was on your account statement was actually what you had at the custodian. Bernie Madoff decided to just make up the numbers because he was the custodian and the broker dealer. That is decidedly not the case here. Your assets live at Bank of New York Mellon, and SSG is the broker dealer with which we do all of the maneuvering within your various accounts. Okay, so much different than the banking world. Okay, so wrapping up, banking crisis. Okay, 2007, 2008. There were many people were buying a lot of houses with that they couldn't afford, and they were reporting income that they didn't necessarily make, and there was contagion all across the country of housing prices that had gone up, houses that were built that people couldn't afford, and it was a much, in my view, different situation than we have today. Today we had an asset liability matching problem with duration, not a we built too many houses, we have made a lot of bad loans problem. Okay, so in my view, the 2007, 2008 great financial crisis doesn't have a lot of parallels to what we're seeing today, at least not from what we've seen so far. Okay, that's not to say some people haven't experienced financial pain, but it's not the wholesale across the board pain that we saw back then. Okay, so I don't know that there's a lot of value to be had on trying to analyze and gain insight or worry about what's going on in the banking world. Going to make a lot of headlines, but again, it seems like the collateral damage has been pretty well controlled. So instead of that, my suggestion, as I always preach to you when we send out our letters every quarter, is we have to control those things we can control. Okay, so these are a couple of the bedrock principles that we're always hammering home, and it always bears repeating. Have enough cash set aside for emergency things. The HVAC in your house goes down, new tires in the car, new brakes for the car, trips that were unplanned that you have to fund. Have some cash set aside for those situations. Insure against calamity affordably. Have an umbrella policy that makes sense for you and your family, so that one car wreck or one slip and fall at your house isn't going to make your entire financial structure come crumbling down. Have an estate plan. If you don't have a will, don't have a trust, haven't talked to an estate attorney, and we've been asking you to do that, do that. There's a lot more to be gained from doing that for yourself than there is trying to worry about the banks out there in the world. Spend less than you make. We tell you that all the time. And then save an appropriate amount. If you're not getting matching funds from your employer, save enough so that you can get the matching funds from your employer at least. Now, these 5 things have nothing at all to do with the Silicon Valley Bank crumbling. But the reason we're sending you this video is that these things at the bottom here will serve you much better than trying to dedicate any kind of worry or studying of what's going on in the banking world. I just wanted to paint the picture for you so that you knew or had a better understanding, at least me trying to explain it, perhaps you understand a little bit better what went on there and how I don't think it's really going to have a direct impact on your finances. If we thought it was going to impact you, we would have already contacted you. Focus on here, and then let the headlines take care of themselves. Then we'll move on from this into the next thing. Okay, so thank you for the time. We appreciate it. You all have a happy Easter, and we will talk to you next quarter.